Hey friends, welcome back to the channel, where we talk stocks, dividends, and building passive income right here in sunny Singapore. Now, today's video was actually requested by one of you, a fellow viewer who asked for a deep dive into Singapore Airlines. So thank you for the suggestion, and if you have stocks you'd like us to review, just drop them in the comments. But here's the big question everyone's asking. Is Singapore Airlines still a high-flying dividend stock in 2025? Or is it about to hit turbulence? Stick around till the end as we break down their latest first-quarter earnings, dividend history, valuation, and what it all means for you as an income investor. And hey, if you find this video helpful, like this video so more Singaporeans can discover it. And don't forget to subscribe to Wealth for You, your go-to for dividend investing and financial freedom. Just a quick disclaimer. This video is for informational and educational purposes only. It is not financial advice. Please do your own due diligence or consult a licensed financial advisor before making any investment decisions. All financial data in this video has been sourced from Singapore Airlines' official first quarter financial year 2025-26 results, released on 29 July 2025, and publicly available figures from Yahoo Finance. Chapter 1. Dividend Investing 101. Now, if you're new here, dividend investing is all about building a portfolio that pays you regularly, like little paychecks from the companies you own. These dividends can be reinvested, used to supplement retirement, or just to pay for your kopi and kaya toast. For Singapore investors, it's especially popular with CPF and SRS accounts because you're often looking for steady, low-risk income. Chapter 2. Who is Singapore Airlines? Singapore Airlines, or SIA, isn't just a national icon. It's a globally recognized airline group known for world-class service, operational excellence, and strong brand loyalty. As of August 2025, the SIA Group, which includes Singapore Airlines, Scoot, their low-cost subsidiary, and the cargo division, operates a combined fleet of over 190 aircraft, flying to more than 110 destinations around the world, across Asia, Europe, North America, and Australia. Now, just to clarify, that number includes both full-service SIA and budget carrier Scoot. SIA handles long-haul premium routes, while Scoot focuses on regional and value-driven travel. Here's where it gets interesting for investors. SIA also holds a 25.1% stake in the newly merged Air India Group, which was formed by combining Vistara, previously a joint venture between SIA and Tata Sons, with Air India, under Tata Group ownership. This strategic move gives SIA exposure to the fast-growing Indian aviation market, a long-term play that could boost network synergies and passenger volumes in the years ahead. So whether you're flying in style to Zurich with SIA or hopping on Scoot to Seoul for the weekend, you're part of a diversified aviation group with both premium and mass-market reach. And that scale, reach, and regional positioning? It matters, especially if you're investing for stable dividends and resilient earnings. Chapter 3. SIA Q1 FY25-26 Results. So, how did Singapore Airlines perform in the first quarter of their new financial year? The 3 months ending 30th June 2025? Well, it's a bit of a mixed bag. Let's start with the good news. SIA recorded a new revenue milestone, bringing in a whopping 4.79 billion Singapore dollars, up 1.5% compared to the same quarter last year. That's the highest quarterly revenue they've ever reported. But when you zoom in on the bottom line, things look a little less sunny. Operating profit came in at 404.5 million Singapore dollars, which is a 14% drop from the year before. And even more eye-catching, or eye-watering, depending on how you look at it, was the net profit, which plunged 58.8% to just 186.1 million Singapore dollars. So what happened? Why did profits drop so sharply despite record revenue? There are a few key culprits. First, SIA had to absorb share of losses from Air India, now that it holds a 25.1% stake in the newly merged entity. Second, interest income fell, which makes a difference when you're sitting on billions in reserves. And third, taxes and operational costs rose, with inflation, maintenance, airport fees, and staffing all contributing to higher expenses. Still, it's not all doom and gloom. SIA managed to carry more passengers than ever before, and load factors remained very healthy, meaning their planes are flying full and demand remains strong. So while profits were down, the business itself is clearly still in motion, and that's an important distinction for long-term investors. Chapter 4. Is SIA undervalued or overvalued? All right, now let's take a closer look at how SIA is valued in the current market. In other words, are we getting this stock at a bargain, or is it already priced for perfection? According to Yahoo Finance, as of early August 2025, Singapore Airlines has a market capitalization of about 20.3 billion Singapore dollars. That's a hefty number. But for a major global airline group, it's not over the top. Now let's zoom in on some key valuation metrics. First up, the PE ratio, or price to earnings. SIA is currently trading at about 8.6 times its trailing 12-month earnings. That's relatively low, especially when you consider that many large-cap stocks in Singapore and around the world trade at 12 to 20 times earnings. So on this front, SIA does look undervalued, or at the very least, reasonably priced. Next, we've got the price-to-book ratio, which comes in at 1.29 times. For an airline, a capital-intensive business that owns a lot of aircraft and physical assets, that's actually quite normal. It's not a deep discount, but it's also not priced at a premium. It suggests the market sees fair value in SIA's asset base. But here's the real standout: return on equity, or ROE. At 18.6%, SIA is generating solid returns for every dollar of shareholder equity. That's a strong number, especially in a high-cost industry like aviation. And it shows that management is putting capital to good use, even in a challenging environment. And let's not forget the cash. In Q1 alone, SIA generated about 800 million Singapore dollars in free cash flow. That's the money left over after covering operating expenses and capital investments. In other words, the cash that can be used for dividends, debt reduction, or reinvestment. So where does all that leave us? Despite the recent drop in profits, SIA is not overpriced. In fact, for long-term investors, especially those focused on dividend income, the current valuation offers a decent margin of safety, backed by solid fundamentals and healthy cash flows. In short, it's not a screaming bargain, but it's far from expensive. And that's not a bad place to be when you're looking for yield in a blue-chip name. Chapter 5. Dividend History, Yield and Sustainability. All right, let's get to the part every dividend investor is waiting for: the payouts. For financial year 2025, Singapore Airlines has declared a total dividend of 40 cents per share. That's made up of 10 cents interim dividend, already paid earlier this year, and a 30 cents final dividend, which is coming very soon. Now here are the important dates to mark in your calendar. Ex-dividend date is 8th August 2025, and payment date is 27th August 2025. So if you're a shareholder on or before 8th August, you'll qualify for that sweet final dividend. At a share price of around $6.80, that works out to a dividend yield of about 5.9%. That's not bad at all. Higher than CPF rates, higher than most fixed deposits, and approaching REIT-level returns, but with the added bonus of a national blue-chip name. But is the dividend sustainable? That's the key question for income investors. The short answer is yes. The payout ratio is about 50%, which means SIA is distributing half its profits while keeping the other half to reinvest or buffer against downturns. They also have strong cash reserves, around 7.75 billion Singapore dollars in the bank, and they generated about 800 million in free cash flow just in Q1 alone. That's more than enough to support their current dividend level. The only red flag? Their stake in Air India. If that investment continues to bleed losses over the next few quarters, management might get cautious and hold back on future increases, or even temporarily pause growth in payouts. But for now, the dividend looks solid, defensible, and backed by strong fundamentals. For CPF and SRS investors looking for steady income, it's a pretty compelling case. Chapter 6. Future Outlook. So, what's next for Singapore Airlines? Well, the travel rebound is still in full swing. The summer holiday season is keeping planes packed, and demand remains strong across many regions. SIA's planes are flying at high load factors, which is always a good sign for operational efficiency. Meanwhile, Scoot, the group's budget airline, is expanding its network, with new routes to Da Nang, Nha Trang, and Kota Bharu on the way. These fast-growing secondary cities in Southeast Asia are part of SIA's broader strategy to capture growth beyond the main hubs. They're also stepping in to fill the gaps left by Jetstar Asia's closure, particularly in regional short-haul routes, another opportunity to gain market share without needing aggressive price wars. On the sustainability front, SIA continues to invest in sustainable aviation fuel and other green initiatives. These aren't just PR moves, they're preparing for future regulation and cost structures as the industry transitions toward lower emissions. It's a long-term game, but a necessary one. And of course, there's the India angle, with SIA now holding a 25.1% stake in the newly merged Air India, following the consolidation with Vistara and Tata Sons. India is one of the fastest-growing aviation markets in the world, and this partnership gives SIA long-term exposure to that growth. But it's not without risk. Air India is still in turnaround mode, and SIA has already taken a hit on its share of early losses. Now let's talk about two big realities every airline faces. First, fuel prices. Jet fuel is one of the largest costs for any airline, making up 20 to 40% of total operating expenses. While prices came down a bit recently, they remain volatile, and SIA recorded a hedging loss in Q1. If oil spikes again, it could erode margins quickly, especially in a competitive pricing environment. And second, the capital-intensive nature of the airline industry. This business requires massive upfront and ongoing investment. Planes are expensive. A single wide-body aircraft can cost more than $100 million. But that's just the start. You also have to factor in aircraft maintenance, landing fees, IT systems, crew training, airport infrastructure, and regulatory costs. Even though SIA has done a great job managing this with strong cash reserves and disciplined spending, the fact remains, this is not a light, nimble business like tech or finance. There are high fixed costs, and that means less flexibility when the economy slows down. For dividend investors, that's worth remembering. Not all of the profits are free for distribution. A good chunk needs to be reinvested just to keep the engines running smoothly. The good news? SIA is better equipped than most. They have a premium brand, global network reach, strong liquidity, and a well-balanced mix of full-service and low-cost operations. They're playing both the premium and mass-market game, and doing it well. So yes, there are headwinds, competition, yields, fuel, and Air India, but Singapore Airlines still looks like a resilient, well-run business in a volatile industry. Chapter 8. Buy, Hold, or Sell. So, after everything we've seen, record revenue, falling profits, strong cash flow, and a solid dividend, what should you do if you're a retail investor in Singapore? If you're a dividend-focused investor using your CPF or SRS, this stock is a solid hold. And if the price dips closer to $6.50, you might want to consider accumulating slowly. The yield is attractive, and the payouts are backed by real free cash flow, not just fancy accounting. If you're looking for capital growth, this might not be your moment just yet. The recent 59% drop in net profit shows that earnings are still facing turbulence, especially with Air India losses and cost pressures. So it might be wiser to wait for clearer signs of profit recovery before jumping in. But if you're someone who just wants consistent income from a blue-chip brand, you're in good hands here. The 5.9% yield is real, the balance sheet is strong, and SIA's long-term fundamentals are still intact. So in short, Singapore Airlines, hold, with a lean toward buy on weakness. A high-flying dividend stock with steady wings. Just keep your seatbelt on and be ready for the occasional bump in the ride. If you found this breakdown helpful, give this video a thumbs up so more Singaporeans can watch it. And don't forget to subscribe to Wealth for You for more investing content tailored to Singapore income investors. Also hit that notification bell so you never miss an update, whether it's on SIA, REITs, CPF investing, or the next dividend gem. Tell me in the comments below, are you buying SIA, holding it for income, or waiting for a better entry point? Thanks so much for watching, and until next time, stay invested, stay informed, and stay chill.